You got to make it your freebie.
Well, I guess it will be.
Yeah. So what happened? So if you aren't ready, that's probably the best reason, because that means you can get, so start keeping up with the stuff as we go along. You'll be okay. So just make this go away. Okay? So don't worry too much about it.
Hi.
Hi, how are you? Hi, Jessica.
I like this.
You couldn't find your quiz?
Yeah, so I couldn't find it in the file. Still can't find it.
What's your last name?
G-U-O.
9.5, right? I got your score recorded.
Yeah. So
Nothing
it's good
to
that I
do.
have a score at least.
The score is the critical part.
Yeah.
If you'd got a bad score, then I'd have been worried because you wouldn't have been able to check. 9.5, you can probably guess. It's one of the multiple choice you probably got wrong.
Okay.
Hey, guys, don't spread it out like this. It's in alphabetical order. It wasn't meant to be spread out like that.
Then it just kind of goes off like that.
Yeah. Let it go. Yeah, I don't know why somebody would pick it up. It's not, it almost never happens. Usually if it happens, it's because somebody was asked to do it and then they forgot to let you know. But if you didn't ask and nobody's given it to you yet, I'll check and see if there's sometimes an exam gets left behind. I don't think it was. I'll check after you. You're welcome.
President, do you mind if I go with office hours on Wednesday?
Yes. Hey, how are you? Good.
I just wanted to clarify with you that we need to call for 10 a.m.
Yeah. Yeah.
Thank you very much.
Okay, so where is everybody? Already off on vacation? So in case you haven't checked, the case is ready for you to download, and my suggestion is you read it before you leave for your spring break. I know you're not working on it during the spring break, but let it kind of fester. I don't think that's the right word I want to use. Kind of marinate in your brain. Let it, so it'll allow you to think about it, but read it before you do it, and meet as a group at least once before you leave if you still can, because I think at least then you have a sense, because otherwise what's going to happen is you're going to come back, it's going to be the 20th, then the case is due the 30th, things will start piling up again. So that's the first thing. The second is that case is really the heart of quiz 2. So if you think about, so I know it's already early to think about quiz 2 because you got quiz 1 back. But remember, quiz 1 is your freebie. So if you did badly, so you got to be a little bit of a Buddhist when it comes to quiz 1, which if you did really well, let it go. If you did really badly, let it go. Now, neither is going to determine your final grade. You've got to kind of keep some distance from that quiz 1. Because it's really to tell you whether the way you're preparing for your quizzes is working or not. That's really what the quiz 1 feedback is if you thought you were ready and you did badly, then that's really an indication that you weren't as ready as you thought you were, and something about the way you got ready didn't work. If you didn't think you were ready and you screwed up on quiz 1, that's a much easier excuse to say, I just wasn't ready. I know you had midterms and other stuff. Some of you had 2 exams, 3 exams. If that was the reason, it's a much easier reason to deal with because the next time I'll be ready. Okay? So those are the two things I want to put on the table. So let's now go back to where I left you, because I know after the quiz you weren't even listening, but we talked about the debt and its cost. And somebody can help me out here. So what should we include in debt? What are the 3 criteria we look for to classify something as debt? What are the 3 things you need? Everybody's looking away saying, don't look at me, please don't look at me. Come on, you can give me 1 out of the 3. So what's the first, Roy? Classify something as debt. But what are the criteria we use to call leases debt? We had 3 criteria. One is as a contractual obligation. It's not an expect. So one is a contractual obligation. Second, which is a contractual obligation. So it's a subset. So contractual obligations can be fixed interest payments. They can be leases. What do they allow though? If you have those payments, what do they also give you a benefit as? They're usually tax deductible. And if you fail to pay them, you can give me the third one. What happens if you failed those? Something bad happens. You're reading off the notes. Something bad happens to you. That's okay. You can read off the notes, right? So at least you knew where to find them. So those are the 3 things, right? And using that, we said all interest-bearing debt, no-brainer. It's debt. Lease commitments, whether they're called operating or capital, debt. So that's the first part. We then talked about the cost of debt. Does somebody remember what the cost of debt is supposed to, what should go into a cost of debt? Go ahead. You're almost saying the answers. Okay. The rate at which you can borrow money, keep going. 1 minus the tax rate, but rate at which you can borrow money short term or long term? 50-50 short. Long term, excellent, you got it. Today or in the past? Oh, today, okay. So it's the rate at which you can borrow money long term today. So think about it, what goes into it? There's going to be a risk-free rate plus a spread on top of it, right? And that default spread will depend on who you are and what your history is and so that's the cost of debt, and you get the tax benefit. So today I want to complete the process. We have a cost of equity that comes from the risk-free rate, the beta, and the equity risk premium. We have a cost of debt that comes from the risk-free rate, the default spread, and the tax benefit. We now have to get weights on the 2 numbers. Before we go there, though, there's one loose end I want to tie up, and that is with what's called hybrid securities. So far, I've talked about debt and equity as 2 separate instruments, but once in a while, you will get a way of raising money that's not quite debt, and it's not quite equity. It's a little bit of each. Think of it as a cross-dressing security. It's part debt, part equity. Here are a couple of examples. The first is in the US, there are some companies that use what's called preferred stock. Here's the essence of preferred stock. You get a fixed dividend. It's actually written into the agreement, fixed dividend. So what's it starting to look like? It looks like an interest payment, right? So I think it's good looking like that. It's fixed. But it's not tax deductible. So it looks like equity. And it doesn't have a finite life. It goes on forever. So that's a hybrid. It's a hybrid because it's part debt, part equity. Here's another one. Have you heard of convertible debt or convertible bonds? What's the essence of a convertible bond? Anybody? Justin?
Certain conditions are stock.
It's not that certain conditions, it is you get the right to convert into shares at
a certain time.
At a certain price, not at a certain time. Say, so you get to decide whether to convert. So let's say that you buy convertible debt in Tesla. Tesla actually issued convertible debt. The interest rate you get is tiny, 1%. You're saying, why would I lend money to Tesla at 1%? The reason you're lending money at 1% is because I give you the right to convert those shares into Tesla's share. I'm sorry, convert those bonds into Tesla shares if the stock price hits 200. So if the stock is at 120, then you're saying maybe it'll hit 200. That's called an option. It's an equity component in a debt. Those are hybrids. If you have hybrids, they're a pain in the neck. I'll deal with the one that's less of a pain in the neck. If you have convertible debt, I'm going to show you how to break it out into debt and equity parts. The debt part is the bond, the interest with the coupon. The equity option can be separated out, in which case you can put the debt into debt and the equity into equity, and the hybrid goes away. Preferred stock, there's nothing you can do. You have to open up a third way of raising capital. There's debt, equity, and preferred stock. And give preferred stock the cost of preferred stock, which is really the dividend yield. So if you have a 7% dividend on preferred stock, that becomes your cost of preferred stock. It's going to fall somewhere between the cost of equity and the cost of debt. So if you have hybrids, if you can make them go away, your life gets a lot simpler. For most of you, this isn't going to be an issue, but for some of you on your companies, there will be hybrids, and that's the process for thinking through them. So now we're ready to bring it all together. We have a cost of equity or a cost of debt. We need weights for debt and equity. Here's the first principle in corporate finance. When you come up with weights for debt and equity, the weights you should be using should be market value weights. As opposed to what? As opposed to what you see in the balance sheet, which are book value numbers. So you'll see an equity number and a debt number in a balance sheet. Those are not the numbers you should be using. They should be market value numbers. Now, one part of you is saying, what if I can't get a market value? What if you have a private company? We'll come back to those. But with a publicly traded company, you have to get market value of equity and market value of debt. Remember we talked about companies sometimes doing crazy things like using one hurdle rate across the board, multi-business company. Here's another thing that companies do that makes their cost of capital not work out. They often use book value weights. This is one of the toughest sales pitches I have in corporate finance, is to convince CFOs that they should not use book value weights. They'll throw everything but the kitchen sink at you to explain why they're okay using book value. There's a reason, though, why so many CFOs like book values. If you look at the background of about 60% of all the CFOs in this country or around the world, what were they in a previous life? They were accountants. And if you're an accountant, what are you told? The balance sheet is sacred. You spent months working on the balance sheet. You're not going to throw that away. So part of this is that pull-up, hey, I'm an accountant, I trust book value. So I'm going to list out some of the reasons they've given me for why they use book value. None of them work, so I'll tell you up front. But I'm going to give you the ammunition when somebody says, this is why I'm using book value, as to why that argument is not going to work. So here's the first argument I've heard from CFOs who stick with book value. They say book value is more reliable than market value because it doesn't change as much. What part of that statement is true? It doesn't change as much. In fact, we know how often book value changes, right? For a US publicly traded company, how often does book value change every year? 4 times a year, every time they redo their quarterly statements. So European companies must have even more reliable numbers because they do balance sheets only twice a year. Hey, I have a proposal. We can make this really reliable by not doing balance sheets at all. The number will just stay stuck. That's like saying a thermometer that stays stuck at 98.6 degrees is more reliable than one that kind of moves around. You'd be dying of a fever at 106. I'm saying, oh, you're okay. Look, it's 98.6. It is true market values change all the time. And it's true that they sometimes make mistakes, but at least they're trying. Accountants not even trying. So dispense with this notion that book value is more reliable than market value. It's just more stable. It's more stable because they don't revisit the number. Second, you'll hear accountants say, I'm an accountant, I'm supposed to be conservative. That's part of accounting. No? I have to be careful about what I do. Not conservative in the political sense, but conservative in the economic sense. I'm using book value because I have to be careful. Here's the counter to that. You're computing cost of capital, right? You can use book value weights or market value weights. For 90% of US companies, which number is going to be higher, market value or book value? Market value is 2.5 times book value across all US companies. So 90% of US companies, market value of equity is higher than book value of equity. Market value of debt and book value of debt are pretty close to each other. You're saying, so what? When I use book value weights, my debt ratio is going to be higher, my equity ratio is going to be lower. You're saying, that's why I want to do it. It's conservative. But then if you use those weights to come up with the cost of capital, Using a higher debt ratio actually will give you a lower cost of capital because the cost of debt is so much lower than the cost of equity. For Disney, for instance, the cost of debt was 3.75% before taxes and 2.4% after taxes. Its cost of equity was almost 9%. So when I weight debt more, I'm going to end up with a lower cost of capital, and that's not conservative. So if you're being conservative, you should be using market value weights. At this stage, they have very little, the fig leaves are going. So here's a final argument they will make. Later in this class, we're going to talk about computing accounting returns, return on equity, return on invested capital, big numbers in corporate finance to measure how well a company is doing. If it looks like I'm crying, it says my spring allergies are kicking in already, so let it go. Right? But just because you use book values to come up with accounting return on equity and return on invested capital doesn't mean you should be using book values to come up with cost of capital. There is no reason, no good reason I've ever heard, maybe you will hear one, for ever using book value weights. So here's the practical next step. If you decide to go the market value route, you need market value of equity and market value of debt, right? If you have a publicly traded company, which is what most of you have, which one of those is it going to be easier to get market value on, debt or equity? Equity, and why? There's a share price and a number of shares, right? I'll tell you, for some of you it's going to be a little difficult if you have two classes of shares, but it's not a big deal. Just add up class A and class B, you get a market value of equity. So market value of equity is easy to get. Market value of debt is much more difficult, and here's why. 80% of all the debt, even in a country like US where companies issue corporate bonds, 80% of all the debt at companies takes the form of bank loans. See the problem you're going to face? Is I can tell you what the bank loan book value is, but there is no market. I can't tell you what the market value is. So here's what investment bankers do, because they can't get market value of debt. They use market value of equity. It's easy to get. They can't get market value of debt. They will dance around a little bit, wave their hands around, and then say, you know what, I'm going to use book value of debt as a number for market value. And most of the time you're going to be okay, except when you're not. What kinds of companies will the market value of debt be very different from the book value of debt? Distressed company. Tell me why. Right? I'll come back to the startups. What's it about distressed companies that makes the market value of debt less than the book value of debt? In other words, the market value of debt is where I reflect the chance. So if I have a company like Glencore, where I'm worried about being paid back, the market value of debt can be significantly lower than the book value of debt because I'm afraid that so using book value is going to give you the wrong number. With startups, you know what the problem is? When startups borrow money, most of them tend to use convertible debt. Why? Because that's the only way people will lend you money. Otherwise, why would they? They know you're not going to pay them back most of the time. So if you do well, they want a share of the equity. So what you see as debt on a startup is really debt plus equity. Most of it is equity. So when people use book value of debt, they've got to be careful. I prefer actually to estimate a market value of debt. So I'm going to take you through the process of estimating market value of debt. And to do this, I want you to remember how you priced a bond in Foundations of Finance. It wasn't complicated, right? You had coupons at a face value. To price a bond, what did you do? You took the present value of the coupons and the face value at the cost of debt for that bond, the interest rate for the bond. So I'm going to take Disney, and I'm going to try to take their book value of debt, which is about $14.288 billion. This is just the interest-bearing debt, and convert it into a market value. So here's the first thing I did. I went to Disney's financial statements, and in one of the footnotes, Disney actually breaks down when their debt comes due, how much debt is in year 1, year 2. So that's a breakdown of when the debt is coming due. I took a weighted average, weighted by how much debt is due in each period, or when the debt comes due, and I came up with 7.92 years. Based on Disney's financials, it looks like their debt collectively is coming due in 7.92 years. Hang in there for just a moment. You're saying, who cares? How does it matter? So that's when the debt comes due. I looked at their income statement, and they had an interest expense of $349 million. So here's what I have. I have the book value of debt, which is what they owe. I have the interest expense, which is what they're paying. And it looks like they're going to have to keep doing this for 7.92 years. But remember, I already have a pre-tax cost of borrowing for Disney. How do I have it? I have a rating and I got a default spread of 1%, which I added to the risk-free rate. So the reason I've sequenced things the way that I have is with the cost of debt of 3.75%, I can now take the present value, treat it like a bond. Now, if this equation looks completely foreign to you, it does, right? How many of you have never seen this equation? Come on, be honest. How many of you have seen the payment button on your calculator? It is the present value of an annuity. When you hit that payment button, present value, that's what's happening. We reap what we sow in finance. The minute we put that payment button in the calculator, who remembers equations anymore? But that's really, so if you don't like the equation, just replace 3 with your present value of an annuity and you get exactly the same number. So that's my present value of the coupons every year for 7.92 years. And at the end of the 7.92 years, I have to pay the book value back. And I discount these all back at 3.75%. You see what I'm doing? I'm treating their entire debt as if it were a gigantic bond with a coupon of $349 million and the entire amount due at the end of 7.92 years. What I get as a present value is $13.03 billion. That is my estimated market value for Disney's debt. You know why it's lower than my book value? If I take the $349 million and divide by 14,288, I get what's called a book interest rate. And in this case, that book interest rate is about 2.75%. Their cost of borrowing is 3.75%. Because their interest rate, the book interest rate is lower than what they can borrow today, their market value of debt is lower than their book value of debt. Justin?
So the total debt on the balance sheet is 14,000.
Right. Because in the table, they don't break all the debt down. So when you look at the footnotes, they don't actually take the entire amount of debt in the balance sheet. So I took whatever debt they broke down in the table and took the weighted average. It could be, but unless I know what the other $2 billion is, whether it's longer term or shorter term, I can't adjust much. Okay? So that is my market value of interest-bearing debt. But you know what I haven't done yet? What did I say I was going to bring into debt? Those lease commitments that Disney has, right? This again, if you have a US company and now increasingly around the world, you will find in a footnote to the financial statements. So I went through looking through the footnotes. Those are the lease commitments. So these are not expected lease payments. These are contractual commitments that Disney has already entered into for next year, 2 years out, 3 years out, 4 years out, 5 years out. And beyond the 5th year, they told me they had a collective commitment of $1.784 billion for the rest of time. So here's what I did. I took the lease commitments for the first 5 years. I took the $1,784 million and treated it as a commitment of $356.8 million every year for 5 years. You're saying, why for 5 years? Well, I looked at what their average commitment was over the first 5 years. And roughly speaking, it looked like they had about $350 million in commitments. I used that as my basis for making that judgment. So let me do a what if. What if I'd found that in the first 5 years, the average commitment was only $175 million a year? You know what I'd have done with that final amount? I'd have treated it as an annuity for 12 years rather than 5 years. So make your best judgment. It really is spreading it out over that extended period. I discount those commitments back at my 3.75% cost of debt, the same pre-tax cost of debt I come up with. What I get as a present value is $2.93 billion. You're saying, what does that mean? That's the debt value of the lease commitments. I'm going to put that on the balance sheet as if it were debt. From this point on, for the rest of this class, if you ask me how much debt does Disney have in November of 2013, I'm going to add the 13,028, that's from the previous page, to the 2,933 million, and my total debt is $15.96 billion. That is my total debt at Disney. That is what I'm going to use to compute debt to equity ratios, debt to capital ratios. It includes the lease commitments. For Disney, most of its debt is interest-bearing debt, right? When I do this for Walmart or Target or the Gap, you know what you're going to find? Relatively little debt is going to be interest-bearing debt. Almost all of their debt is going to take the form of lease commitments. In 2019, accountants are finally going to come to their senses on this. Both IFRS and GAAP will require all companies to start doing this across the board. Now it's optional. It's not even optional. It's not done. In 4 years, every company will. But I've been doing this for 21 years, or maybe more than that, 25 years, because I can't wait for accountants to come to their senses. because it's taken them an awfully long time to do what should have been common sense right from the beginning. Now remember, with retailers and restaurants, this takes the form of those new sites they have. But it's not restricted to them. There are other businesses which enter into contractual commitments where you have to do what we did with leases. I'll give you an offbeat example. Any Yankee fans here? Come on, you can put your hand up. I'm not a Red Sox fan. If I ask you whether you're a Red Sox fan, don't put your hand up. That's not a good idea. I'm a Yankee fan. 2009, when the new Yankee Stadium got built, I decided to take my kids to opening day. And that way they can tell their grandchildren I was at the new Yankee Stadium the day it opened. So I get tickets on, I don't know, StubHub or something, the bleachers. And I got tickets for me and my 3 sons. You're saying, what about your daughter? I offered her a chance. But here's the question she asked me. Will there be Dippin' Dots there? And I said, Kendra, what does that even mean? She said, if there are no Dippin' Dots, if you can't guarantee, I'm not coming. And I said, Kendra, you're not coming. So I took my 3 sons. Opening day, we show up at 12:30, the game. Beautiful day. We're sitting out in the bleachers. And it's a great view. If you've ever been in New Yankee Stadium bleachers, it's actually a better view than you get from up on the grandstands. And the Yankees come running on to the field. And all I can think of is debt and equity. You're saying, this is so sick. You're sitting at the Yankee Stadium. Because here's what I saw. And if any of you Yankee fans, you will recognize this page and perhaps weep. This is what I saw on opening day in 2009. A guy called Mark Teixeira runs out to first base, and here's what his contract guarantees him. Guarantees him $22.5 million every year for the next 8 years. That's about $160 million in present value of commitments. There was my cheap infielder at that time, a guy called Robinson Cano. He had only $7.5 million left for 4 years. Then I swing around. Here's my old infielder, Derek Jeter. At that time, I had $19 million that I was due to him for 2 years. And then I looked at third base, and there was an imposter on opening day. But the guy who was supposed to be there was owed $27.5 million every year for 9 years. On the mound was a guy called CC Sabathia. He was owed $23 million a year for 7 years. And behind the plate was a guy called Jorge Posada, who was owed $13.5 million for 3 years. Every one of these is a contractual commitment. In fact, baseball is perhaps the most stringent sport in terms of commitments. Because in the NFL, you get hurt, they can cut your contract. Baseball, you have to keep paying these guys after they blow their knees out for the next 6 years. So when I got home that day, I took the present value of all of those commitments. Forget about the outfield. I don't even look at the outfield. This is just the Yankee infield. Present value of my commitments at the pre-tax cost of debt for the Yankees of 6% is $561 million. You say, what does this even mean? If you decide to buy the Yankees, according to Forbes right now, they're worth about $2.5 to $3 billion, right? You look at their balance sheet, you will see no debt. But don't fall under the illusion that just because you don't see debt on the balance sheet, they don't have the equivalent of debt, because they have $561 million of debt in the form of player commitments. If you're a soccer fan and you're planning to buy AC Barcelona, you look at that team and you take Messi and you take Neymar and you do the same thing. Whatever your sport is, take the sport, take the present value of commitments. You'd be amazed at how much debt these professional sports teams have in the form of player commitments. So when you think about debt, don't stay focused on interest-bearing debt. It could be any kind of commitment that weighs you down. And you can see how big these commitments can be for some companies. So let's go back to the regular slides. Okay. So my total debt for Disney is $115.96 billion. So I have now, for Disney at least, the way to compute, did I compute? Yeah, the way to compute the total debt for the company. For Disney, the market value of equity is easy, share price times number of shares. Sometime over the next week, I'd like you to try this on your company. This, of course, presupposes that you have a company. I will not ask you that question. I will assume that you have a company by now. Do the market value of equity and the market value of debt. Compute the weights, because those are going to be the weights used to determine what your overall cost of funding is for your company. Now, for Disney, I have these numbers, and here's what the numbers look like for Disney. So this is the page I've been leading to for about 120 pages. Everything we've been doing for pretty much the last 6 sessions, this is the page I'm leading towards. So let's start with the cost of equity. The risk-free rate is 2.75%. Somebody remind me where that number came from? I'm doing everything in US dollars. In November of 2013, this was the 10-year T-bond rate. So I got my risk-free rate. Beta 1.0013. Anybody remember where that number came from? It's a weighted average of the 5 betas. So remember that we broke Disney down into 5 businesses and came up. That's my bottom-up beta. It's a levered beta because I'm looking at the equity. 5.76% equity risk premium, which reflects what? Not that Disney is a US company, but where Disney does business. 82% US, 18%. Everything has a place. My risk-free rate is where I show my currency choice. My beta is where I show the businesses that my company is in. The equity risk premium is where I show where my company operates. I've got a cost of equity of 8.52%. My market value of equity was number of shares times share price, which is 121.9 billion. Cost of debt, risk-free rate, same risk-free rate, 2.75%. A default spread of 1% based on their actual rating, single A. Marginal tax rate of 36.1%. My cost of debt is 2.4%. My market value of debt from the previous 2 pages is 15.96 billion. Based on what Disney had in November of 2013, Disney is about 88.4% equity, 11.6% debt. The only rule you cannot violate is the weights always have to add up to 100%. Any other answer, of course, will throw you off. My weighted average cost of capital is 8.52% times the weight of equity, 2.4% times the weight of debt, which gives me a cost of capital for Disney as a company of 7.81%. Yes?
You never talked about it when you were doing betas, but when you were finding the debt to equity ratios, the leverage beta.
I use this 15 exactly.
Is this what it's on the internet, or is this like your way of doing it?
This is on the internet, or is this your way of doing it? My way of doing it is on the internet too. So you've got to be a little more specific about what on the internet you're talking about.
Yahoo Finance, for example. What numbers are you?
Come on. If you're learning finance from Investopedia and Yahoo Finance, you're in big trouble. Hey, let it go. Hey. So if you ask me, is this the standard way of doing it? Let me rephrase it. Is this the banking way of doing it? Probably not, because bankers are incredibly lazy, incredibly sloppy. That's why I told you at the start of this class, I am not interested in teaching you how bankers do things. They will come to their senses eventually, but this is the way we should be computing debt ratios. If you think about debt as a commitment you've got to meet. This is the way you should be running a business if you're thinking about debt ratios. So this is the cost of capital for Disney as a company, but Disney's in 5 different businesses. I've got a cost of capital for each business. So this is the rest of the table. I did the betas by business earlier. Now I have the rest of the table. And I did the same thing for Vale, where I did a cost of capital for each of the businesses in both US dollar terms and real terms. I have for each business now a cost of equity and a cost of capital. In fact, I can complete this process. I can do the cost of capital for Tata Motors by taking their cost of equity in rupee terms times the weight of equity, which is about 71% equity. The cost of debt in rupee terms, you have to be consistent all the way through, gives me a cost of capital in rupee terms of 12.15%. For Baidu, in Chinese renminbi, that cost of capital is 12.4%. And for Bookscape, I computed 2 different costs of capital. One as if it were a public company, 6.57%, but it's not. Given the fact that the owner is not diversified, the cost of capital I get for Bookscape is 10.3%. Remember we started off about 8 sessions, maybe 9 sessions ago on a search for the minimum acceptable hurdle rate? I now have minimum acceptable hurdle rates for each of my companies, for both just the equity investors and for the entire business. In fact, we're going to go back and forth between cost of equity and cost of capital in this class. We can't use them interchangeably. You can't pick and choose which one you want to use. I'm going to give you a simple rule to decide which of these rates you're going to use. But try this for your company, because this is the starting point for doing almost everything in finance. Whether you're doing a valuation of a company, a corporate financial analysis, you have to come up with costs of equity and capital, not just for your company, but for each of your businesses. Okay? You have the tools. Just use them to come up with actual numbers for your company. So now let me lay out what to do with these two different numbers. So for Disney, for instance, the cost of equity I came up with is of 8.5%. The cost of capital is 7.8%. If I let you pick, you're going to pick the lower number because it's easier to beat that 7.8%. But you don't get to pick. Which one you use will depend on how you measure returns on your projects. For the moment, this sounds abstract, but if you think like an equity investor, and you look at net income, which is the income you make, and you measure it against the equity investor, that's called return on equity, the comparison has to be the cost of equity. If you look at an overall project, you look at the collective income you make, and you look at the total amount invested in the project, that's called a return on capital, or return on total investment, you look at the cost of capital. You tell me how you compute income and cash flows, I'll tell you whether you should be looking at the cost of equity or the cost of capital. If you don't quite get it now, when I start using actual numbers with projects, you'll see exactly what I'm talking about. So it took us a while to get there. So I'm going to read out the sub-principle, and I'd like somebody to flesh out each of the words. So this is what I showed you in the very first set. I said the hurdle rate should reflect the riskiness of the investment. So somebody help me here. When I'm looking at equity, how do we measure the riskiness? In a publicly traded company, we measure the riskiness with a beta on the assumption that investors are diversified, and we use that beta to come up with the cost of equity. With debt, we measure riskiness with default risk and a default spread, which we use to come up with the cost of debt. So we now have an explicit measure of riskiness. And should reflect the mix of debt and equity used to fund the project. Those are the weights in the cost of capital. So the hurdle rate should reflect the riskiness of the investment and the mix of debt and equity used. So I know it took us a while, almost more than a third of the class to get there, but that's the first step in corporate finance. Okay, so now let's turn to the second step. You know what the theme song is when you think about how we measure returns in corporate finance? How many of you have seen Jerry Maguire? Come on, most of you haven't? One of the great movies of all time. And of course, in Jerry Maguire is one of my favorite movie sayings of all time. Cuba Gooding Jr. says, "Show me the money." Notice what he didn't say. He didn't say, "Show me the accounting profits." He didn't say, "Show me the operating earnings." He said, "Show me the money." In corporate finance, we're single-minded about the way we think about returns. Returns should be based on how much you get in cash flows, when those cash flows come in, and I'm not going to let you play games with words, because anything you throw into the mix, I have to bring into my returns. So for the next 4 or 5 sessions, that's what we're going to talk about. Why cash flows? How do we measure cash flows? How do we bring them into returns? And how do we bring all those buzzwords into returns? So let's start off by drawing a distinction between earnings and cash flows. I'm not an accountant, in case you've mistaken me for one. And every morning when I get up, I get down on my knees, I look up at the skies and say, thank God I'm not an accountant. But I guess somebody's got to do that dirty work, including some of you. I'm glad that you're there to do it. But I'm glad I don't have to do it. But looking at accounting from the outside in, which is what I am doing, I see, and maybe I'm simplifying accounting too much, I see 2 broad principles governing how accountants think about the world. The first is this notion of accrual accounting. What does accrual accounting require you to do? Anybody? Come on, you've taken an accounting class. You can't tell me what accrual accounting requires? In other words, record transactions when they happen. So if I sell something on December 30th, even though I haven't been paid for it yet, I have to record the revenues when I sell it, and I have to record expenses associated with those revenues, even though I might not have paid for them yet. You think as opposed to what? There's a much more honest way of doing accounting called cash accounting, or I call it checkbook accounting. You know how cash accounting works? You record revenues as you get paid. You record expenses as you pay them. When I did my taxes yesterday, and I'm glad I got them out of the way, I had the option of using cash accounting because I'm an independent business. I'm not I'm not incorporated. So I'm allowed that option, which means all I have to do is look through my checkbook to see who paid me last year. That's my revenue for last year. And look through my checkbook to see who I paid. And those are my expenses. Cash revenues minus cash expenses, that's my cash flow. You can't do that if you're a publicly traded company, and you cannot do that if you're a privately incorporated business. There you have to do accrual accounting, which means you've got to record transactions as they happen. So file that away. The second is accountants have this fixation, maybe even an obsession, with classifying expenses into three types. I still remember my first accounting class. The accounting professor came in with 3 cardboard boxes which he'd labeled. The first cardboard box he labeled operating expenditures. The second cardboard box he labeled capital expenditures. The third cardboard box he labeled financial expenses. And he said in accounting we're religious about the way we classify expenses. Any expense that creates a benefit only in the current year goes into operating expenses. So if you pay rent or you got materials used for the production, that goes into operating expenses. Any expense that creates benefits over many years goes into capital expenses, land, building, equipment, machinery. And then if you have expenses associated with the use of debt, interest expenses, those go into financial expenses. And everything has its place, right? If I have operating expenses, which financial statement will I find them in and where? Where do operating expenses go in financial statements? They go to the income statement right below the revenue line. So you subtract out the operating expenses. What happens to capital expenses? Sorry, somebody? It gets put in the balance sheet the year that you spend the money, but in the years after, what are you allowed to do? Depreciate or amortize that expense. Don't bring repayment. That brings in the way you finance the capital expense. That's a separate issue. So when you have capital expenses, they show on your balance sheet, you get, and that depreciation or amortization goes into your income statement. And if you have financial expenses, you subtract them from operating income to get to net income. So operating expenses go into the income statement, capital expenses go into the balance sheet and get depreciated, financial expenses go into the income statement below the operating income line. It's all very neat and nicely tied up. I didn't know that this professor was lying when he said that accountants are religious about the way they classify expenses. Because I've learned in hindsight that they're not. That not all capital expenses go into the capital expense box. How do I define capital expenses? Expenses that create benefits over many years. Can you think of one very big capital expense that accountants routinely put into the operating expense box? I'll give you a clue. Think pharmaceutical company. What is it? R&D expense. It is the super capex if you think about it. What do accountants do? Screw it up big time. Throw it into the operating expense box, and they'll give you all kinds of song and dance about, oh, it's so uncertain. So what? It's still an uncertain capex. Operating capital and financial expenses. You know why earnings are different from cash flows? It's because of those two accounting principles. To get from accounting earnings to cash flows, and this is a very simple thing to remember, and this you'll use it in valuation and capital budgeting, there are only 3 adjustments you need to make. So if I give you the accounting earnings on a project or a company, first thing you do is you add back the depreciation and amortization. Why? No, let's be simpler. It is non-cash. So when accountants subtract, I'm trying to check out a depreciation. If any of you guys are writing checks out to depreciation, let me know. My name is close enough to depreciation that I'm glad to change my name and collect all the checks. Imagine the billions I could collect every year. Depreciation amortization is not a cash expense. I'm going to add it back. I'm going to subtract out capital expenditures. Why? Because even though the accountant says, don't worry about it, I still have to pay for the land, right? I can't go to the landowner and say, you know what, this is a capex. I usually don't pay for capex. No, I still have to pay it. It's cash leaving the company. So I have to subtract out capital expenditures. So add back depreciation and amortization, subtract out capital expenditures, and then I'm going to subtract out change in working capital. And this throws people off. People do it routinely. They don't even think about why they do it. Remember how accrual accounting worked? You sold something on December 30th. You had to show it as revenues even though you hadn't been paid yet, right? So because you haven't been paid yet, what shows up on your balance sheet reflects the fact that you haven't been paid yet? Accounts receivable. And you have to record expenses even though you haven't paid for them yet. That's accounts payable. Use items you bought last year. That's inventory. You leave items for next year. That's inventory. Changes in working capital convert accrual earnings into cash earnings. So add back depreciation, subtract capex, subtract change in working capital. You've gone from earnings to cash flows. So here's my first question. Is it possible for a company to have huge positive earnings and negative cash flows? Yes. Tell me how. What happens? What has to be true for that company to go from positive earnings to negative cash flows?
Fixed costs that companies don't
No, the fixed costs, no, it doesn't matter because you remember earnings are already after fixed costs.
expenses for the goods they're providing.
No, that's not going to do it either because it's earnings. I'm not talking about revenues, right? So if you have fixed costs, you have expensive items, it's all being subtracted out. And after subtracting out, I still have big positive earnings. Don't make this more messy than it has to be. I've already told you how do you get from earnings to cash flows. Yes? Really big capex, but most companies that have really big capex also have really big depreciation, right? Because if both are big, then they offset each other. So complete the story. You need really big capex and small depreciation. What kinds of companies is that going to happen in? If you have a growing company, what's going to happen is your capex is going to be big. Your depreciation reflects your past. So growing companies, you can actually have positive earnings and negative cash flows. In fact, that's the rule rather than the exception. So a company like Facebook can make billions of dollars in earnings but have negative cash flows because you spent $22 billion on WhatsApp. That's a capex. So you can have positive earnings and negative cash flows, especially at young growth companies. Can the reverse happen? Can you have negative earnings and positive cash flows? This is the dream for every Asian and Latin American business person, private business person, is to report a loss year after year after year. You're a big time loser, right? What's the advantage of reporting a loss year after year after year? Is you don't pay taxes. Let me offer you a proposition. Would you be okay being labeled a loser if I let you deposit $5 million in cash flows every year in the bank? Everybody thinks you're a loser, but every year you put $5 million into the bank. Hey, you know what? You can label me whatever you want, the biggest loser. I'm okay as long as I get to keep the cash in the bank. I'm a very rich, biggest loser. So the basic proposition here is earnings and cash flows can give you very different numbers. And in finance, what do we say? When the two numbers are different, which one should you trust? Don't think too long. Trust the cash flow. So I'm going to start off by giving you my defense for why I trust cash flows more than earnings. You cannot spend earnings. Try. Walk across the street to that Starbucks. Actually, change my mind. Walk down to Broadway. That Starbucks is a nightmare. It's like 5,000 people waiting in line, right? Walk down to Broadway. There's always a Starbucks. Just open up your laptop or your phone, look for a mobile, whatever the Starbucks Wi-Fi is. You'll find one within 6 blocks of you. So walk over to that Starbucks. Get to the front of the line. Order a venti cappuccino. How much is it now? $5.50 or so? $5.35, something like that. Offer to pay with earnings. Say, look, I am in this undergraduate business program at Stern. It's a very good program. I think I will have a big earnings stream ahead of me once I graduate. Can I pay you in earnings? Unless you're a really stupid cashier, he's going to listen to you and say, that's nice, but I need to see some cash. You cannot spend earnings. You can spend cash. If you're ever tempted to go with accounting earnings on any proposition, I have 2 words for you. Winston Groom. No idea what I'm talking about, right? Have you ever heard of Winston Groom? Any of you heard of him? He's actually a guy who wrote a few books. Do you know? In fact, most of his books you probably haven't heard of, but one of his books was a book called Forrest Gump. the 1980s, he writes this little cult classic. Some guy at Paramount reads the book and says, this would make a good movie. So he goes to Winston Groom and says, hey, we'd like to make a movie out of your book. And Winston Groom's very flattered. Nobody's ever wanted to make a movie out of one of his books. They offer him a contract. He reads the contract, looks pretty good. It entitles him to 5% of the accounting earnings on this movie. It's mistake number one. Then there's a little footnote that says, accounting earnings will be computed using studio accounting standards. Mistake number two. He signs the contract. Not a mistake, because the movie gets made. And Tom Hanks stars in it, becomes a huge hit, becomes one of the 10 highest grossing movies, wins a few Academy Awards, and poor Winston's at home waiting for the check, and it doesn't come, and it doesn't come, and it doesn't come. He says, maybe they lost my address at Paramount. Let me call them and see what's going on. He calls Paramount and says, where's my 5%? They say, 5% of what? Of the profits you're making on this movie. He said, we're not making any money, we're losing tons. So how can you be losing money on one of the 10 highest grossing movies of all time? So you can come in and look at our books. Goes and looks at the books, and sure enough, they're reporting a $150 million loss in the movie. So he keeps going down the line items, and he sees his line item for $200 million. He says, what is that? So we haven't named it yet, but it's a provision. For what? For future bad movies. Studio accounting standards raises its ugly head. Studio accounting standards actually lets you set aside a portion of the revenues from a successful movie to cover future bad movies. Now, this might explain some very strange phenomena we've been observing for the last decade. Like all those Eddie Murphy movies. Maybe this provision got really big. It was November. The studio said, we have to make 3 really bad movies really fast. What can we do? Call in Eddie. He's really good at doing that. He'll dress up as a fat woman, a thin woman. He'll blow up himself, whatever he needs to do. Okay? Let me ask you a question. Do you think Paramount made money on Forrest Gump? Their books show they lost money, but they make money. Absolutely. Do you think this is fair to Winston Groom? Depends on your definition of the word fair. He, in fact, sued. The case didn't last very long. The judge read the contract, said, Mr. Groom, did you put your fate in the hands of accountants? He said, I guess so. Well, you got what you deserved. Case dismissed. I get reminded of the contrast between earnings and cash flows every 6 months. I have 10 books with 3 different publishers. They all screw me over, so this could be about any of them. Every 6 months, they'll send me a royalty statement. Now, if you look at my contract, it looks really good. I'm entitled to 15% of the net proceeds on the book. The accountant who invented the word net should be tarred, feathered, and hung from a tree. Net proceeds. Any of you bought the Applied Corporate Finance book? How much did you pay? $140. I would not pay $140 for War and Peace in first edition. $140 for a damn paperback. It's obscenely overpriced, and I'm getting 15% of $140, right? I should be getting like $21. So every 6 months when I get my royalty statement, here's what I check. I take, because they tell me what my total royalties is and how many books were sold. And I divide the royalty by the number of books to see how close to $21 I get. You know the most I've made on a book is? $1.50. There's many a slip between the gross and the net. I don't know what happens between the 21 and the $1.50. That's what, and there are line items on that statement. I look and say, what the hell is that? My least favorite line item of all, about 6 years ago. I look at my royalty statement. Half my royalties disappear for what's called a year-end adjustment. What the heck is a year-end adjustment? The year-end came up on you unexpectedly? Let me give you a clue. If it's October, the end of the year is coming right down the corner. And what exactly do you do at the end of each year? Throw half my books into the Hudson? So I call the publisher and say, I need to talk to somebody about this year-end adjustment that seems to be eating away my royalties. They put me in touch with the legal department. And guess who I'm talking to in the legal department? A lawyer. And if you've ever talked to a lawyer, 25 minutes into the conversation, you don't even remember what you started off this conversation with. You're so completely turned around. He said, look at clause 7C of your contract. I look at it. I have no idea what it says. It was written by a lawyer, 4 lawyers, 2 lawyers. There is a mention of a year and an end of a year and an adjustment, but nothing I can make sense of. So I hung up the phone and I devised my petty revenge. And you guys can be the beneficiaries of this petty revenge. Here's how I write my books. I write it a chapter at a time. Then as I write the chapter, I put it online. Why? Because I want to get feedback on mistakes, typos, etc. So chapter 1. So my investment valuation book, for instance, is 35 chapters and 1,100 pages. So each chapter, chapter 1, chapter 2. I get to chapter 35. The whole book gets done. It goes to the printer. It gets published. It gets into the bookstores. I forget to take the chapters offline. I remember the first time it happened. My publisher calls me in a panic. He says, "What are you doing?" I knew exactly what he was calling about, but I decided to act dumb. I said, "You seem to be a little upset. What's going on?" He said, "You put your entire book online." I said, "So?" So you're going to lose sales. I said, "What do I care? I make $1.50 a book. If I made $21 a book, maybe I'd care more. Call me back when that's true." That was 6 years ago. He hasn't called me back yet. Okay. Every one of my books is online. I have to act like it's accidental. So one of my books, for instance, is under enchilada. Don't ask me why. Mexican menu items are one of my favorite devices. So you click on enchilada, the entire 1,500 pages of investment valuation downloads. This way I can claim it was accidental. I said I meant to put a picture of an enchilada there. I don't know what happened. The book must have got in by accident. So what I'm saying is get online, get on my website, start clicking around on all the things that don't seem to belong on my website. Especially menu items from Mexican restaurants, tacos, enchiladas, what a quesadilla, I don't know what. So whatever you think of, click on it. By the time you're done, you'll have 10 books worth of stuff on. Don't try to print it off on the printers here. Okay? That's just going to just clog up the printers. Do it at work or somewhere where people don't know what you're doing. Okay? So earnings or cash flows. Okay. Second, the cash flows have to be incremental. What you're asking is, what will this project do? And you're going to see examples of this. Often you see income statements and cash flows for projects, and many of these items have nothing to do with this project. Your job is to take them out and focus on what's incremental. And finally, you have to time weight those cash flows. Why? Because you'd rather get the cash flows earlier rather than later. That's what discounting does. A good measure of return on a project will be a time-weighted incremental cash flow return. You ready? Here's what we're going to do. We're going to look at a bunch of projects, and my definition of project is everything. So here are some examples of projects. You go out and you make a decision to enter a new market, a new country, a new business. That's a big investment. A decision to acquire another company is a big investment. A decision on new ventures within your company is an investment. A decision to change inventory models is an investment. A decision to put a water cooler on the 3rd floor of your office building is an investment. Small to large, revenue to cost cutting, they're all investments. So what we're going to talk about is a very broad template, no matter whether it's big or small, how to look at an investment. And I'm going to focus on 4 examples to kind of bring this home because they kind of span the spectrum. So the first thing I'm going to do, and these are all hypotheticals. This is the one part of this entire class where I've got to make up stuff, because no company ever lets you see the insides of their investments. But these are all based on reality. They're based on things that the company's already done. So first thing we're going to do is we're going to look at a project for Disney. A new theme park that Disney is planning to build in Rio de Janeiro. Let's call it Rio Disney. I'm going to give you the specifics for this project. And you guys have to be the decision makers. I'll be your number cruncher. So at each stage in the process, I'll feed you numbers in the project. And based on what you build up from these numbers, I want you to decide whether Disney should open Rio Disney. The second is I'm going to look at a new iron ore mine for Vale in November of 2013. And no fair bringing in hindsight and saying, I know iron ore prices are going to collapse in the next 2 years, therefore I'm not going to open the mine. We'll talk about how to deal with uncertainty about commodity prices in that context. Third, I'm going to talk about creating an online bookstore for online book retailing outlet for Bookscape. And I'll give you again the facts, and you have to make decisions. And finally, I'm going to talk about Tata Motors doing an acquisition of Harman Audio. Why? Because they want the best audio systems in their Jaguars and the Tata Motors. So we'll go through an acquisition. 4 very different investments, but all of them I'm going to go back to first principles. Cash flows over earnings, incremental cash flows over regular cash flows, time-weighted incremental cash flows wherever I can find them. So ready? So let's start with Rio Disney. Before I do this though, any of you, anybody in this class who's never been to a Disney theme park? It's like a Super Bowl commercial, right? When this class is over, what are we going to do? We're going to send these people to Disney World. Don't worry, I'm not raising the money to do it, so if you don't want to go to Disney, it's not happening. But even if you've never been to a Disney theme park, you kind of know how a Disney theme park is set up, right? Every single Disney theme park around the world shares one particular type of park in common. They all have a Magic Kingdom. And what does every Magic Kingdom have in the foreground? A castle, usually a fake castle, but that kind of goes without saying. But one of the easiest ways to figure out whether you know your Disney trivia is to ask you whose castle it is. Because it depends. It depends on which Disney theme park you go to. You didn't know that, did you? That in Euro Disney, it's Belle's castle. In Disneyland, it's Sleeping Beauty's castle. In Disney World, it's Cinderella's. You're saying, what about Snow White? Snow White never had a castle. She hung out with that hut with those 7 dwarfs, right? So that doesn't work. So usually you have a castle. You go through the castle, and where are you? Come on, you got the Disney trivia stuff. You're in the happiest place on earth. Surrounded by parents dragging screaming kids back and forth. They say, this is the happiest place on earth. There's a Dumbo ride in front of you with a line which is 5,000 people long. And then you have all these little Snow White rides. At least one of them is usually broken. Yeah, but that's Magic Kingdom. So the first theme park that this Rio Disney is going to be a Magic Kingdom. It's going to take a year to build. And it's going to be operational at the start of the second year. The second theme park in Rio Disney is going to be an Epcot. Any of you been to Epcot? Scariest place to me in the face of the earth. Right? There's a lake, a fake lake, of course. That goes again without saying. Surrounded by the world as Disney sees it. And the way Disney sees it is usually there's a pavilion for that country, and there's a restaurant. They're big on restaurants. Chinese pavilion, Chinese restaurant. Mexican pavilion, Mexican restaurant. Basically, in 3 hours, you can eat your way around the world. Though they do miss a few countries. I remember the first time I went to Epcot. I walked around, and I walked around again. I walked around a third time. I said, they're missing India. I can see you missing Luxembourg or Monaco. How do you miss 1 billion people? That's okay. That's just my pet peeve. But Epcot is basically the world as Disney sees it, built around a lake. So the second theme park, that's going to take a while. Putting an artificial lake in Rio, surrounded by the world, it's going to take 2 years, year 2 and 3, and be open at the start of the 4th year. I'm going to cheat and give you all the numbers. Remember, I'm your number cruncher. I'm going to cheat and give you all the numbers in US dollars. Why is that cheating? Where's the theme park going to be? In Rio, which means the cash flows are going to be in Brazilian reais. I'm going to cheat and give you everything in dollars, and later I'm going to come back and ask, would your decision have been different if I'd given you everything in reais, and we'll see if it changes or not. Okay? So let me set up the process by giving you some facts about these theme parks, and I'm going to use this to build up my number crunch. Disney has already spent $500 million researching this theme park, getting licenses. Keyword is already spent. And if it decides not to open the theme park, if you decide not to open the theme park, you're not getting the money back. So file that away. You're saying, who cares that I'm not getting the money back? It might come into your decision-making process. Magic Kingdom is going to cost $3 billion to build. $2 billion right away and $1 billion a year from now. Epcot is going to cost $1.5 billion to build. $1 billion at the end of year 2 and $500 million at the end of year 3. So you can see the money is going to get spread out. So collectively, you're going to be spending $4.5 billion over the next 3 years. Those investments will be capital expense investments, so they'll get depreciated over time. And I'll give you the schedule that I use to depreciate them. So that's your big investment. Here's what the revenues are going to look like. Before I go here, though, remember I'm your number cruncher? You're the big decision maker, right? You turn me loose and say, come up with the numbers for this new Rio Disney theme park. I'm sitting there in front of an empty spreadsheet. How do I start populating the spreadsheet? This is kind of a generic question because many of you, if you're low people on the totem pole, which is what you're going to be when you graduate and go to work, this is what you're going to be asked to do. Go fill out that spreadsheet. So let's say you are sitting there saying, what the hell do I do? Who do I ask? Everybody asks, I have no idea. Come up with numbers. How do you come up with numbers on revenues and expenses for a new theme park for Disney? Look at what they already have, right? That's what I did, is I went and looked at the Euro Disney numbers and the Disney World numbers and the Disneyland numbers. Of course, you're saying, but those are in different countries. I know, but I've got to start somewhere. So what I have here are my projected revenues at Magic Kingdom. You're saying, how come there are no revenues in year one? I'm still under construction. I could have been creative and charged people to come and watch it be constructed. I didn't think about that. People would probably pay, right? You know, because they'll send Snapchat stories about Disney construction and them being in it. Whatever it is, I didn't think of it. I wasn't creative enough. So that's why there's nothing in year one. It picks up in year two. Epcot, I've got to wait till year four. You're saying, what is that third column? Remember all those properties that surround the Disney theme parks, those hotels you built? I've assumed that for every dollar they get in revenues at the theme parks, they'll get 25 cents in revenues of the hotels. What did I base it on? I looked at Orlando, where all Disney World is surrounded by the Swan, the Dolphin, and the other hotels. There, Disney makes about 25 cents in revenues at the hotels. So you can see how I'm using existing theme parks as my basis. So those are my expected revenues for the next 10 years. No revenues in year one. That should be 1.25 billion, 1.7. So basically, I've sum up from them. I did in billions for the first 4 years and then switched to millions. But you can see I start small with about 1.25 billion, and by the time I get to year 10, I've got 5 billion. Remember, you're the decision maker, so keep your eyes on these numbers because at some point you got to say yes or no. So clearly, by year 10, the theme park is making a lot of revenues. Now comes the expense part. The operating expenses of running these theme parks, the direct costs, will be 60% of revenues at the theme parks and 75% of revenues at the resort properties. Again, that's based on what's happening in Orlando right now. For every dollar they get in the theme park, 60 cents goes back to maintain the theme park. And what? In keeping the theme park clean, all those people who manage the lines, all those people who constantly surround you at a Disney theme park, they have to be paid. That's a 60%. The 75% of the resort property is exactly the same thing. This is the actual direct cost of running those hotels. Now comes the interesting other part. This is going to be a project for a big company, right? And if you have a project for a big company, the accountants have this nasty practice of allocating expenses to you because you're making revenues. So I'm going to assume that this theme park, because it looks like it makes revenues, accountants are going to allocate G&A costs to this theme park. What's G&A? What's the expense? It's general administrative. What goes in there? Many of these many companies, you'll see it's $1 billion, $500 million, $2 billion. What goes into G&A costs? I know it's general, but we can go back and forth. General administrative, G&A. What exactly does it mean? Sorry, what? Compensation, if it goes to my employees, it's a direct expense, right? Management, we're getting closer. What is it about compensating certain managers that is a problem? They don't actually deliver revenues directly, right? If you ever worked in a big company, and many of you will go to work for a big company, I guarantee this is going to happen. You're going to look at entire floors of the building your company's in and say, what do those guys do? They come in, they leave. They're big expenses, but they never create revenues. That drives accountants crazy. For instance, CEO salary. CEO never brings in $1 in revenues, right? So if I pay somebody $50 million, that's expense without revenue. So what the accountant does, he goes around gathering all these expenses which don't create revenues, and he goes looking for a place to put them. So if you have revenues, he said, oh, you look like you have revenues. Have $500 million. He said, no, no, please, I don't want it. No, that's not a choice. That's allocated G&A. 2/3 of those expenses have nothing to do with this theme park. You're saying, why are they allocating it then? Because you're part of the Disney family. Again, file that away. 1/3 of the expenses have something to do with the theme park. 2/3 have nothing to do with it. Now here's my depreciation schedule. Remember I said that capital expenditure is going to be depreciated? This is how much I'm going to depreciate each year. You're saying, how do you come up with these strange looking numbers? In much of the US now, your depreciation is set by the tax code. They actually tell you what percentage of the asset you can depreciate. You no longer have the kind of discretion you had 20 or 30 years ago. So in this case, this is the amount of depreciation you're going to be allowed to take. I'm taking it. And I'm also going to set aside some money to maintain the theme park. Why? What happens if you put no money back into the theme park? It's going to look really crappy. Your rides are going to start breaking down. You've been in some theme parks like this, right? Where you go and everything's I mean, there are some Six Flags parks I've gone into where I wish I hadn't even gone in, where it's clear they haven't put any money back. The reason they're putting it back is not because you love spending money, but because you want people to keep coming. Okay? And how much you spend will depend on how long you intend to run these theme parks. So if you intend to run it for just 10 years, you might not spend as much, but if you intend to run it for a longer time, you have to put more money back. And finally, for the other assumptions, there will be some working capital requirements for this theme park, inventory, accounts receivable, whatever. They're expected to be about 5% of revenues. And you have to make the investments at the end of each year where those working capital requirements come up. There are two choices. You can make them at the beginning or the end. I've assumed that you have to make the investments at the end of each year. The tax rate I'm going to use for this theme park is 36.1%. So these are going to be the numbers that drive my estimates, those revenue numbers, the expense numbers, the depreciation numbers. So what I'd like to do is actually pull these numbers together first by first estimating what the amount I'm going to be investing into this theme park is, and also figuring out what my working capital needs will be each year. So what you have on this page is basically every time I make a capex, it goes into book value. Every time I depreciate something, it comes out of book value. So each year what I'm doing is I'm starting with my book value, looking at the new investments I make that adds to the book value, subtracting out the depreciation. That is my book value. So if I listen to my accountants, that's what I've got invested in this theme park in year 1, in year 2, in year 3, and it changes. The working capital each year is based on revenue. So there's no working capital in year 1 because I have no revenues in year 1. Once my revenues start to kick in, this is the working capital each year. So there's my total amount invested in this theme park. So you're going to have a lot of money tied up in this theme park, right? So when you're saying, who cares? When you look at how much money you will make on this theme park, this is what you're going to scale it to. So if I say you're going to make only $25 million on this theme park, and you're investing $4 billion in the theme park, and say, no way am I investing in this theme park. So this is going to be the base you got to keep in mind when you think about how much money this theme park needs to make for it to break even. So I start working. I open up a spreadsheet and I start projecting numbers. So there are my revenue numbers, there are my expenses, the direct expenses in the theme parks. There's the depreciation and amortization and the allocated G&A. And I have my operating income on this theme park starting in year 1 going through all the way through year 10. So in year 1, I have an operating loss. No surprise there because the theme park's not even operating. So basically it's just expenses. Year 2, even though it's operating, I still have a loss. Why? Because only Magic Kingdom is open and my expenses are still ramping up. As my theme park matures, I start making money, at least in the accounting sense. I'm making accounting earnings. So there's my operating income over time. I net out the taxes and I get operating income after taxes. Let me pause right there. In year 1, what did I say? I lose $50 million, right? I have a negative tax of $18 million. What am I assuming I'm going to be able to do with my loss in year 1 that allows me to get that $18 million negative tax in year 1? What are the two things I can do when I have a loss in the company? Carry it forward. And the other is, this is one project of a big company, right? So if I'm losing on this project, what can I do with that loss? Offset it against income in other projects. If you have a choice, which would you rather do? Wait and get your tax savings later or get it right now? kind of loaded that question, right? You should get it right now. So what I'm assuming is I have a $50 million loss in year one. I'm going to get the tax savings right away. And that allows me to get those losses down. So that's my after-tax operating income. You ready? Your job is to make a decision, right? So if I showed you this page and said, would you invest in this project? You have sufficient information to make that judgment. It's making a lot of money. Why do you guys get so greedy? $421 million in year 10, that's a lot of money, right? But what do you have to keep in mind? You also have a lot of money invested in this theme park. $421 million is a lot of money, but it depends on how much you put into the theme park. So what I'm going to do is I'm going to pull together 2 pages. This page gives me my income from the theme park. The page I showed you earlier shows you how much I've invested in this theme park. I'm going to divide the after-tax operating income by the amount invested in this theme park, and I'm going to come up with what's called a return on capital or a return on invested capital. This is a buzzword in finance that gets used over and over. But if you look at that second last column, one is based on the average book capital each year, but they're both around 4-point-something%. So what am I telling you? Based on the income on this theme park and the book value of the investment, it looks like you can generate about 4% in returns on the theme park. Is that good enough? Let me give you some choices that you can compare it to. I could compare it to the risk-free rate. Hey, it beats my risk-free rate, so that's good, right? Why not? It's not risk-free. If it were a risk-free investment, I could use the risk-free rate. It's a theme park. All kinds of bad things could happen, so I can't use the risk-free rate. I could give you the cost of equity for Disney as a company, or maybe even the cost of equity for the theme park. Is that a good comparison? How did I compare my return, estimate my returns here? I looked at the total operating income and the total capital invested, not the net income and the equity investment. I looked at the total capital and the total operating income. Do you see where I'm leading you? Because I looked at the total return on capital, the cost of equity is not the appropriate number because that's what just the equity investors want. So cross out the risk-free rate because it's not risk-free. Cross out the cost of equity because this is a return on your overall capital. So now we're getting closer to an answer. So it's got to be a cost of capital, right? So here's my final question for today. Should I use the cost of capital for Disney as a company or the cost of capital for Disney theme parks? Yes? I'm glad you remembered, right? So basically, remember that we went through the movie Lone Ranger 2, and this is exactly what we're setting up to. But you said it. So you don't quite buy into this? Is that what you're saying yet? I want you to buy into it on your own. It's not because I said it. I want you to think through why it makes sense to use the cost of capital for the theme park. So we're going to stop there on Wednesday. I'm going to add that fact that this is a Rio de Janeiro theme park and what to do about it. But this is going to be the basis for our comparison. Just add up the long-term debt and short-term debt right off the balance sheet. So it's whatever the accountants call debt in the balance sheet.
So on our part, we could just look at the balance sheet.
Yes.
Just a quick question. So for this, was it supposed to be the levered beta? Because I thought that this was you meant that you were looking for the beta. Like you know, like there's three
When I
equations.
say beta, it's always going to be 11
Always
beta,
11
unless I
beta?
specify an unleavened beta. Why would I? No, that's. So anytime you see the word beta, it's always 11 beta.
Okay. All right. Thank you.
Because otherwise, there's nothing to do in part B.
Yeah.
You already did
That's
part
why
A.
I was like confused by it. All right. Thank you.
Okay.
Hey, Professor.
Yes.
I was wondering where we pick up the quizzes.
They're right here.
Thank you.
Yeah.
I'm Fernando. I was wondering if I have a question about the quiz. I can
Yeah.
hear right now.
Just ask me right now.
Yeah. In this part, something that I didn't got clear at the end. In the part of the beta, when it says like after the acquisition, I didn't have to take into account like anything of Tesla, right?
Can you not take into account anything of Tesla? It's the acquisition. What do you mean you don't take anything of Tesla?
I was in the part of here
Right.
when I want to take the cost of the rate, like the debt over equity.
This question is not even, I just asked for an unlevered beta. So debt and equity is not even an issue. All I'm asking is the unlevered beta, right?
Yeah.
So the debt to equity comes into play only because you want the unlevered beta of Tesla. And once you get that unlevered beta, the unlevered beta for the company will be a weighted average of the two unlevered betas. Google's unlevered beta and Tesla's unlevered beta weighted by their firm values.
Okay.
So,
Yeah, I was confused about that. I was like, how do I get this?
Yeah.
Because I understood my mistakes on the other ones, but I was like, I don't get this one.
okay, good.